Well, what's good, traders? It's your boy Caution. It's your boy. On this video, we're gonna be basically covering the basics of forex trading, ranging from what is forex, forms of trading, what is traded in the forex market, how you go about choosing a broker, trading times and sessions, terminologies used in forex, forms of trading. I've already went that. So without any further ado, let's get to it. Let's get to it, ladies and gentlemen. So, you're probably asking yourself right now, what is forex trading? Like, it's crazy that what it means is actually in the terminology. Sure, okay, so forex trading actually refers to the global market where we actually buy and sell currencies. The forex market is the largest and most liquid financial market in the world. It has a turnover like a daily turnover of about 7 trillion, maybe more, maybe wrong on that, traded on a single day. Like that means every single day trillions of dollars circulate in the forex market. How crazy is that? So anyone can participate in the forex market, from individuals, also called retail traders, and small businesses, to large financial institutions. Currency trading can be done for many reasons, including hedging risk, speculating, speculation, and managing international trade. I hope that actually helps on what it what forex actually mean. So you're probably asking yourself right now, what is actually traded in the forex market? Okay, so the answer for that is actually in the term, like foreign exchange. Like, okay, so what is traded in the forex market? To keep the answer simple, forex currencies, like foreign, like currencies are traded in the forex market. So the forex market is all about buying and selling different currencies. For example, you might buy euros, euro dollar, and sell them for yen, for Australian dollars. There are hundreds of different currency pairs that you can trade. But the most popular ones, also referred to as the majors, like the Euro USD, USD JPY, GBP USD, USD chef. But you can also trade what are called crosses, like Euro GBP, GBP chef, and Australian dollar CAD. There are also others called exotics, which are pairs that involves currencies from emerging countries or markets like Mexico, South Africa, and Turkey. An example of a pair from those countries, the most famous one is USD ZAR, which is actually where you trade USD for South African rand. Okay, so I've actually covered that now. Moving on to more pressing matters will be uh how do you go about, choosing trading times, and what are trading sessions. And as I was saying, ladies and gentlemen, this will show you what session it is currently. This is baby pips. You can just search up baby pips session, what and just search up baby pip sessions. So this will always show you what session it is depending on your um location. So it will always show you the current session or the dominant session at the time of you checking. So as you can see right now, this shows what session it is. So you're probably asking yourself, like, why are there different sessions? Which session should I choose? All of those different questions. So as you can see right now, the session is by the green indication, it's actually London session right now, and it's crossing over to the New York session. Where is the New York session on this? Oh, yeah, yeah, the New York session from the London session. As you can see right now, it's the London session. So how you go about actually choosing which session you're about to trade or you want to trade, this will entirely depend on the currency pair you want to trade. You don't just choose randomly. So obviously during London session there are pairs that are more dominant than others. Especially during the New York session, the pairs that are most dominant are gold, USD, CAD, chef, Euro, GBP. So what do I mean by this? By this I mean that you can't just trade NZD JPY during the New York session. I mean, you can do that, but what we're looking for here is liquidity. We're looking for movement. So most times than not, like, those pairs will actually consolidate when it's not their session. So right now you might be asking yourself, I want to trade USD JPY. So if you want to trade JPY, the smartest thing to do will be to choose when USD JPY is most moving, or when there's the most liquidity in the market for trading USD JPY. So to go about that, you'll actually consider the fact that uh, when is USD most liquid, or when is there like the most movement in USD JPY. So like I said, USD is most active during the New York session. So you'll have to go about waiting for the New York session to actually go about trading to USD JPY for the most success in the market. And then if you are planning to trade something like GBP, you actually have a choice right now. You could actually choose London session or New York session to go about trading. The smartest thing, like free tip here, I'm gonna give you a free tip. If you want to actually like get the most out of your trading or out of the markets, like don't trade two pairs that are most active during the session. For example, what do I mean by this? I said USD is active most during the New York session. GBP is also active during the New York session. CAD, gold, chef, euro, you know. So the smartest thing you shouldn't do is trade euro and USD while they are both active, because that will mean that you have two pairs that are currently, active in the market. Like both the euro are trading and USD is trading at the same time. The markets are trading. So what you can do to actually combat that, or a smart way to go about avoiding that, or to actually get the most movement, is look at the major sessions and consider which one is active while the other isn't active. For example, you can look at I said during New York session gold is liquid, or if I haven't said that, I said that now, so you know that. So gold is more active during the New York session. So what you can go about doing is gold and USD are both active, so that's something to avoid. So what you can do is actually go about trading something like let me see, GBP CAD. Yeah, GBP CAD. You can go about trading GBP CAD in the sessions where one of the pairs is active. I get it, every time there's a pair, there's something called the major pair and the minor pair. The major pair is always on the left, the minor pair is always on the right. So if you want to actually go about getting the most movement in the market, do something like trade USD JPY during the Asian session. Why? Because JPY is very active during the JPY sessions, because this is when the JPY people, or the Japanese, whatever you want to call it, the Asian sessions is active. So the people who trade JPY are active. So there's more movement in the market during the Asian session to trade JPY pairs. And then if you want to actually go about trading during the London session, look for something like GBP JPY. Why? Because during London session, JPY is less active than what? Than GBP. So this will actually give you a kind of imbalance, and imbalance means what for you? Means movement, and that's what you're actually looking for. So this will give you some sort of strategic advantage over the market, or in the market per se. So that's how you actually go about choosing a session. You don't just decide to trade JPY during the New York session, unless if one of the pairs that you decided to trade is active while the other isn't. So that's how you actually go about, I wouldn't say outsmarting the market, because there are no tricks in the market according to my perspective. So now let's move to something trade. Oh, we already went over trading sessions, so let's go to the forms of trading. Okay, there's different forms of trading ranging from the different types of market, the different forms of trading ranging from scalping, day trading, and swing trading. So scalping, as the name might suggest, are people who just go to the market looking for short-term movements. So when a scalper looks at this chart, like they are only looking to get in and out, like they're not trying to stay in the market for a long time. There are people who just go in and out, in and out. So a scalper, when he sees an opportunity to sell, he's gonna probably take a position here, close here, position here, close here. When going to the day traders refer to the people who, to the types of traders who open a trade and close it on the same day. The definition for that is quite simple. Swing traders look for the long movements. They might look to enter a position here and actually let it run, close it somewhere here, open here, let it run, close it somewhere here. So Swing traders are people who actually go about looking for big movements in the market. So those are the types of trading or forms of trading. And then the forms of markets refers to the crypto markets or crypto trading, stock trading, and the forex trading, which is the one I'm actually emphasizing on right now. So in the markets there are also these things called brokers. So brokers are actually work as, let me say, brokers work as middlemen. Like they are middlemen, they are the middlemen between you and the market. So here is you, a trader, linked to what? Linked to your broker. And your broker is actually linked to what? To the global market. This is the actual market. So this is how a broker works. This is the simplest definition of that I can make about what is a broker. So this is you open a position, your broker actually opens the position for you in the live market. Well, that'll actually depend if it's an in-house or out-house market. There's different types of brokers. Some brokers trade in-house, some brokers trade out-house, if I can say. So what does that refers to? That refers to in-house brokers that are the type of brokers where you open a position, they actually, those people are crazy, they actually open a position against you, you know. If you decide to buy GBP, JPY, they open a position in the opposite, you know, meaning that when you lose your money or you lose your trade, they keep the profit. But it's not really a scam per se, because when you win, they also give you your capital, you know. So that means that your traders actually go in-house, depending on what type of trader you are. If you're a person who's actually, you know, profitable, they'll actually go about opening positions in the same direction as you know. So when you decide to buy, they'll know that you're profitable, and then they'll decide to buy with you. But if you're a newbie and they know that you lose most times than not, they'll actually go about trading against you, and then they'll keep the money you lose, but they'll also give you a profit when they know that you're actually a good trader. This is what how it goes. Good trader opens trade on their broker. The broker takes the position, does what? Takes it to the live market, and then on the upper side I'll actually indicate what happens. Okay, newbie trader opens trade, goes to broker. Broker doesn't take the trade to the open market, it actually goes in-house, you know. That's what it means by an in-house trade. So when you lose, they keep their profits for themselves. If you win, they actually give you a profit. So for you, or from your perspective, it's actually a win-win situation, because you don't even know which traders are actually out-house or in-house. Like they don't tell you that, you know, and you still get your profit. So it's not something I wouldn't really be concerned about, you know. I've actually mentioned, moving on to that, let's go to currency pairs. Currency pairs, the major and minors, just like I mentioned, and then the one on the left is the major, the one on the right is the minor. Okay, going back to the broker. So how you choose a broker will actually depend on uh, how much capital you actually have for trading. If you're a person who has small capital, you'll actually look about researching and looking for a broker who will actually accommodate your needs, who will actually, you know, like let you open micro lots instead of like major lots, you know, and small entries. Like you'll be able to actually open large trades with a small account, if you may call it that. It's called micro accounts. So that's what you'll actually be looking for. The language, you know, the language that is used in trading in order for you to have some advantage of actually knowing what people means. Okay, so the most important, or actually, you know, focus on the most important terminologies in trading. Some of the most common forex terms are pips, spreads, leverage, lot size, pips, which refers to the smallest unit in price and is actually equal to 0.0001. A spread is the difference between the bid and ask price of the currency pairs. Leverage is the ability to control a large amount of money, which is relatively a small investment, and a lot size is the number of currency unit you're trading. I hope that actually clarifies what it means. Or let me actually clarify more about lot sizes. In forex, the lot size is the number of currency units that you're trading. The standard lot is about 100,000 units. So what does this mean? This means right now when you open a position by 1, I get the 0.01, the 0.10, then there's 1. It actually refers to the standard lot, which means when you open a position with the standard lot, aka 1, I guess that's what you may call it, you're actually buying 100,000 units of a currency. But you can also trade mini lots, which will be 10,000 units of a currency, or micro lots, which refer to 1,000 units of a currency. That's 0.01. 10,000 units refers to 0.10. That's 10,000 units of a currency. So the lot size you actually choose will depend on, your account size and your risk tolerance. For example, if you have a small account, you may want to trade mini or micro lots to minimize your risk. Or if you're a more experienced trader, you may be comfortable trading standard lots. Like, I hope that actually, clarifies that what I meant about the lot sizes. So I've already mentioned what 0.01 refers to. Okay, so moving on to that, where I'm actually going to focus more about leverage. What is leverage? Okay, leverage is a key concept in trading, in forex trading. It is the ability for you to control, a larger money than you actually have. So you're basically using the broker's money to actually open positions. But how this works is that when you lose money, you know, you'll actually lose more, and when you make money you'll actually make more, depending on what leverage you're using. So a basic example of a leverage, you can just use what most brokers actually uh, offer is a 50 is to 1 leverage. So a 50 is to 1 leverage refers to when you're trading, for example, $1,000. This will mean the broker will actually give you access to $50,000. So this will mean you're trading as if you have $50,000. What does this mean? This goes back to, if you're making more money, you'll make a lot, and if you're losing, you will lose. So while leverage can increase your potential profits, like I said, it also increases your risk. So it is important to understand how it works and use it responsibly. More on that. Okay, into more detail, like the into go into more detail with the leverage, you're essentially borrowing money from the broker in order to trade. Again, the higher the leverage, the less capital you need to control a certain amount of currency. For example, like I said, 50s to 1 leverage, you can also control 50,000 with just 1,000 USD. This means that your potential profits and losses are magnified. So if the trade goes your way, you can make a lot of money. But if it goes against, trust me, you won't like that. So you're probably asking me, or asking yourself, how I came to the conclusion of $1,000 refers to $50,000 in order of like how much capital you get access to. So to get that, you actually multiply your balance by the leverage you have. So in my example, you'll be trading $1,000 multiplied by 50, which will actually give you $50,000, which will be the excess capital you'll be using, but not your balance. So those are the terminologies. Going more about spread. Spread basically comes from the sell and bid price. And let me use this for you to understand. Sell, ask and bid price. This guy in between here. Okay, so this guy here between the ask and bid price is called the spread. This is actually how your broker actually makes money. Whenever you open a position, like, it actually starts as negative. I don't know if you've noticed that. Yeah, so the reason it starts off negative is because your broker takes something called commission from the funds that you actually use when you open. So they charge you for opening a position. So for example, right now, if you believe that the market is gonna go down and you open a sell, it won't be open with the buy price. It will be open with the sell price. So if the market is at right now, the market is at 1.87.685. When you open like a buy, it won't be open here at the bid price. It will be open at the higher price, which is your broker taking the commission from this actual position. So that's how the spread actually works. So the higher the spread, the more amount of money like your broker will actually take from you opening the position. That's why it's actually good to use a regulated broker, because they usually regulate the spread that they charge you. So the smaller the spread, the better. The bigger the spread, the more money they actually take from you. Quick tip here. Usually when you're trading exotics are the ones where they'll actually, have larger spreads, because like there's less volume of traders trading and they are very volatile usually. Yeah, so those are the terminologies.